Hello, everybody. It's Ronald here. Today, we're going to be talking about credit scores, how to improve your credit scores, and why it matters for getting a mortgage. Let's get started. So, how is credit score calculated? These are the factors of credit score. So, payment history. Paying your bills on time is the most important. Never miss payments. So, go on all your loans, credit card bills, car loans. Make sure you understand when is the payment date, and if you pass that date, your credit score will be hit. For me, I personally like to do try to set up auto payment for everything. And for credit cards, I like to pay them to zero all the time. I check every 2 weeks and I pay everything. Actually, my own credit cards, I pay them to minus like a few hundred, so I'm never late. And here's another part, credit utilization. Basically, it's how much you're using divided by how much credit is available to you. So by paying it to $0 all the time, I'm using 0% of my credit, and that's good. If you're maxing out your credit cards, that's going to be bad for your credit score. So if your credit card company ever offers you a higher limit, that's actually good, because let's say you get, from $5,000 to $10,000. If you spent $500 on your credit card, it would have been 10% credit utilization. Now that increased to your maximum borrowing capacity is $10,000. You can now borrow, $500 and it's only 5% instead of 10% credit utilization. Credit age. So you want to make sure you keep your existing credit cards active. Don't disregard any of them. Um, Try to spend at least one transaction on each credit card every month or two to keep them active. And this shows that you can see here, keep credit accounts open even if you no longer use them. And credit mix. If you have credit card, line of credit, and mortgage, student loans, and you're not late with the payments, and you have a low credit utilization, that's also good. So actually, to improve your credit score, you can actually ask for a line of credit, and you don't have to use it. Maybe use $10 and pay it back on time, and that's actually going to be good for you because you have better credit mix. This again, how much you owe is has to do with the credit utilization. Hard increase, such as getting a car loan and getting that last part of a mortgage. When I There's a soft pre-qualifier and a pre-approval. When you do a actual hard pre-approval for last step of buying a house, that will hit your credit score, but it's very little and it's temporary. Also, when you get a new credit card, it might hit your credit score a bit too. So if you're planning to buy in a few months, it's okay to open some new lines of credit. Your credit score will drop temporarily, but it will increase your credit mix. So let's say I want to buy in half a year. Right now, I can go out, get a few more credit cards. There's a lot of free ones. Just Google free credit cards in Ontario or wherever you live. And you can get a car loan if you need only if you need a car. Get a line of credit, and then use all of them. Don't pay cash. Try to use credit if you can to build the activity and pay on time. Basically, you're proving to lenders that you can borrow money and you can pay it back. And that is a pattern of behavior that they want to see. So, how to increase your credit score? You can review your credit reports once in a while to make sure there are no mistakes. Yep, pay on time, keep credit utilization low. This is limit applying for new accounts. So this is just before you get a mortgage. If you don't have too many accounts and you're planning to buy in like half a year, then yeah, then it's okay. Go ahead and apply for new accounts because as you can see here, you need a good credit mix. Okay. So now you want to keep your old accounts open because it goes to here. It says credit age. When I was younger, I was kind of stupid. I had a few credit cards that were really old and have really high limits, like $30,000, 10 years old. And I almost closed them. I was like, oh, I don't use this card. This other one has higher rewards. Now, good thing I didn't close them and I started using them again. And I saw my credit score rise from around 700 to 8. I'm at like 860 now. So it takes a while to increase your credit score, at least a few months. So please do it right now if you're planning to get a home soon or get a mortgage. Okay. So even utility and rent payments in your name helps with credit score if you pay it on time. So that's it. And now I'm going to tell you the implications of, having good and bad credit for the purposes of getting a mortgage. So you can see here the magic number is 680. If you are 681 versus 860, it doesn't matter, okay? You can still have a GDS of 39%. That's gross debt service. You can Google that. But basically, this is going to be your mortgage principal plus interest plus uh, taxes plus maintenance, half of maintenance plus heating divided by your income. Okay, so the higher the percentage, the more you can borrow. So let's say, for example, here, this example client has 96K income, 35K down payment, and they can right now afford a house at $37,000 because a $37,000 purchase price gives them a gross debt service ratio of 38.85% GDS, which is lower than the 39%. And they're allowed to go up to the 39 because they have 680 credit score, above 680. They have 700. But what if you drop to 670? See, now your mortgage is declined, and now you requires a 106 income. You see, when you get to 700, you only need 95. So basically, let's see how much purchasing power drops if you go below 680. And not to mention, your interest rate might be higher depending on the lender. Lender might charge a higher interest rate for a low credit score. So no matter what, it's good to have high credit score. So before they can afford 370,000, but now they can afford, as you can see, as I lower the purchase price, GDS gets lower because your housing interest and principal payments get lower. See, whoa, went down by a lot. Used to be 370. Now you can get approved from 370 to 330. So that's a $40,000 drop in purchasing power just because your credit score is lower than 680. And finally, if your credit score is below 650, they might not even give you a loan. They might not even consider your income. Let's say a husband and wife are one's 700 and the husband is like, let's say 600. They might not even be able to count the husband's income. He can't even be on the mortgage because his credit score is too low. Um, I mostly focus on buying and selling houses, but in terms of leases, if you're able to ever wanting to lease a property, actually landlords want to see above 780. So actually, it's funny purchasing. For credit score, you just need over 680. But for leasing, you want to have as high as possible. I used to represent a client. They had 780, and someone else had like 800 something. They chose the 800 something one. So um, yeah, lease, if you're looking for a lease, you need to improve it even more, focus even more. But if you're already at like 750, you're looking to buy a property, don't worry about trying to increase it to like 800 because it won't make a difference. It won't have any additional benefit for you. There are some lenders that might offer slightly lower interest rate, but this is very rare. So, yeah, let me know if you have any questions. My contact information is below in the comments, and my phone number is there. Add me on WhatsApp or call me. I'll be happy to help you with purchasing a home and connecting you with some kind of mortgage lenders and mortgage agents. All right, take care, guys.